When justifying an action that you intend to take in procurement, a key part of your business case will be to estimate the cost that will be incurred and the price an organization may need to pay, which is why by the time you're done with this, you will be in a position to understand the types of data that can provide price and cost information, the difference between direct cost and indirect cost, how to produce estimated cost and budgets, estimating the cost associated with whole life asset management. And let us start with types of market data that can provide information on cost, price, and pricing strategies. And to start us off, I just want you to understand that there is a difference, okay? There's a difference between cost and price. Price is what a seller charges for a package of benefits offered to a buyer, while cost is what the buying organization pays to acquire the goods or services purchased. And so cost is actually going to be more than what you've paid the seller, okay? So the amount of money you've paid the seller, that is just price. But then there is more to it, okay, than that amount of money that you've paid. It could also include things like installation, maintenance, operating, insurance, and disposal costs. And having said that, you also need to remember that the seller also has costs, okay? When they're giving you their price, they've also factored in cost, and that is important. So what you see to be cost to you may not really be what the seller is seeing as cost, but you both have costs. That's the one thing you need to have at the back of your mind. Finding out about prices and finding out about cost are two different things. The truth is there are several ways, okay? There are several ways that suppliers can communicate their prices, and these will include things like the supplier may have a standard price list of price schedule available for the public. Prices may be quoted on request. So these are things like request for quotation come in, because when you say, look, we are interested in buying these things and we need for you to give us a quote, okay? So you're requesting for quotation, RFQ, okay? Which, even request for information just depends on what information you're interested in. But if you're just interested in the price, then yeah, we're talking about RFQ. So that's another thing, another way suppliers could actually provide you with their prices. Prices may be arrived at through negotiation, okay? Prices may be determined through competition, for instance, in auctions, where somebody says, this is how much we are selling this thing, or rather, this is the starting price, okay, for us to sell these things. So 50. Anybody who wants to give us more than 50, 60, 70. So that's auction. At that point, what are you doing? You're just bidding for, prices. Number 5, prices may be determined by market. For instance, when dealing with commodities. And having said that, right, with all that, when you're doing your research in relation to price, your research is actually take two shapes, okay? So we have primary data, also known as field research, where you collect data from a relevant source. And then you have secondary data or desk research, which could involve looking at what has been reported. So you could actually go out there, okay, get the information directly, or you could just do things on your computer and, try to figure out the price. So that's primary and the other one is secondary. So that's the thing. Anyway, as you continue, if you have a question, you ask. Now let's talk about pricing strategies. Pricing strategies refer to the factors an organization will consider when selling an end product or service. And there are various, strategies that can be taken by sellers or suppliers. And some of these will include things like market penetration, in which case they're using a low price to gain the market share. So you start with something small, like a small number, okay? So that you get more people, and then probably you'll increase it in future. Number 2, market scheming. This is used in absence of competition. So a new product is priced high, okay, to make a large profit from purchases from initial customers. When competition does occur, the price is usually lowered. And then we have cost plus, okay? So in this case, you're going to figure out the actual cost associated with producing that thing, the direct cost associated with that thing, and then you add your margin or your markup. So if you're producing anything, if you're producing whatever, this thing. So what are the direct costs associated with producing that thing? So once you have your direct costs, then you'll still need to add your markup, okay? So that you can cover for other overheads. and also to generate profit. So that is cost plus. Next, we have marginal. Okay, so in this case, once all fixed costs have been recovered, the cost of any extra sale is the only variable cost associated with the product or the service being sold. This permits a pricing below the total cost to be profitable. The idea is this way, okay? You're producing, again, let's say you're producing the same thing, you're producing this stuff, right? And you've already produced enough, to cover for your fixed cost. Let's say you've produced like 200. And after selling the 200, you're covering your fixed cost because that's a thing, right? Now, you still have an extra room to produce, say, 20 more. So the 20 that you'll produce, that money won't go towards the fixed cost because you've already covered your fixed cost with the first 200. So now in this case, those extra 20, how do you price them? And you can price them at any price, below the original, selling price that you sold the first 200. And so the only thing you'll have to worry about here is the variable cost. Remember, variable cost, you're going to incur those costs with the level of production. Fixed costs, on the other hand, you've already taken care of. So usually you factor in the variable cost when you're doing the marginal pricing. You factor in the variable cost, and then you can add something there, and then it becomes a price. So the price could be lower than the original price. So that's the thing with that. Next, we have the going rate. Okay, so pricing a product at a similar level to the competition. We have premium. Okay, pricing product or service high because the market is prepared to pay for it. And this is usually associated with premium brands, with reputation for quality or luxury. I mean, you see that with things like sports car or even those designer clothes, designer bags. Why do they sell them at a higher price? Not because they are like whatever. It's just because that is what people are going to pay for. That is what people expect. That is what people associate certain type of status with those things, and therefore they're going to pay the premium to get those things. It is the same thing with the sort of high-end restaurants. I mean, you're just eating food, right? But the ambience plus all that stuff sort of makes you feel, yes, I'm going to pay this amount for this particular thing. So that's premium pricing. We also have buyer-based pricing, okay? So pricing at a level the buyer will pay. And then we have discriminating, okay? Such as off-peak, special rates for children and pensioners, etc. Now that is the thing with pricing strategies. Again, look, there are many, but for the sake of these, we are sort of limiting it to those ones. But of course, as we continue, at any point, if there is a question, I keep on repeating that. So don't sit there with your question. Now let's move on to the next thing. In this case, let's try and understand the cost. And let's start with the components of the cost base. When you are dealing with manufacturing, okay, when you are in the manufacturing space, your cost will generally fall, or that will generally be based on the following 3 things. So the first one, we have raw materials, that is the inputs to the manufacturing process. We have labor, things like the wages or salary of workers employed by the organization. And then we have overheads. In this case, there is the expenditure which cannot be directly identified with the output of any particular production item, but is associated with keeping business process up and running. What are we talking about here? So think about it. Again, if you're producing something, if you're producing these whatever lens covers, right? So the cost of the plastics and things like those ones associated with producing that, those are direct costs, right? But then you have other costs like the cost of the CEO of the company, the cost of the tea person, okay? The delivery guy who gets you letters from the post office, whatever it is. Those people, right? The cost you're incurring in relation to those people cannot be directly attributed to whatever it is that you're producing, this thing, okay? But you still need to pay those people because they keep the business running. So that, or those, are what you refer to as overheads, right? So labor, okay, raw materials and overheads. Your expenses are going to be, based on those 3 for the most part. And let's talk about the difference between, or the identification of direct and indirect costs. And that is a very common way of classifying costs, okay? Direct costs or indirect costs. Direct costs are costs which can be directly identified with a specific sellable unit of output. If you are dealing with something like a textbook, okay, so that's the thing, you're dealing with textbook. In this case, your direct costs are going to be things like direct materials such as paper, ink, glue, direct labor such as wages paid to employees working on the production of the book, direct expenses such as royalty payable to the author of the book. Now, indirect costs or overheads are expenditures on labor, materials, or other items which cannot be identified with a specific sellable unit of output. And in this case, in the case of the book, you're talking about things like the cost of, say, some, lubricant that is used to maintain machines, okay? Probably the money paid to sales staff or security guard. So you see, those are indirect as far as the book is concerned, rather the textbooks that you're selling. To understand this, let's look at it from a practical angle. Imagine someone is starting a business selling flowers. Now, there are things which this person is going to pay for. There are things which this person will have to buy. Okay? So in short, there are things and costs that the person will have to incur in their flower business. So we're talking about things like premise, vases for the flowers, marketing, print, okay, things like flyers, posters, an online presence, cash register, flowers, etc. The person will also have to consider the sort of products that is going to sell. So yes, it's a flower business, but what exactly are you going to be dealing with? So in this case, things like cut flowers, bouquet, wreaths, okay, and they may even, okay, consider potter plants. The costs directly associated with making those things, okay, whether it's the bouquet or the wreaths or the, cut flowers, those are going to be direct costs, right? In this case, these include the flower, okay, the ribbons, and paper to wrap the flowers, cost of any staff directly involved in preparing and selling the product, while any other costs, okay, that is going to be incurred when they're running that business, that is not directly attributed to those flowers and those products, that is going to be indirect cost or the overheads, okay? In this case, things like building costs, equipment, and business rates. Now, of course, not everything is just going to be direct and indirect. We have other costs that are going to be, think about it. Take something like water, okay? So the water that is being used on the flowers, that is going to be, the cost of that is going to be direct, right? But what about water that is being used in other things? Like probably to clean the building or to in the toilet or whatever it is. So how do we, so it's just water, but then it has some aspect of it is going to be direct, some aspect of it is going to be overhead or indirect. My point is just for you to not be very binary when it comes to these things. So you just assume it's direct and it's indirect and there is no shade of gray in between. So that is direct and then indirect. Again, as you continue, if you have a question, you ask. Fixed cost and variable cost is another way of looking at costs. The idea is that some costs don't change with the level of production. Those are the fixed costs. So usually something like rent, whether you sell something or you don't sell something, as long as the premise is under your name, you're going to pay rent. That's fixed cost. Variable costs, well, they'll vary with the level of production. You're simply saying that if it costs you, the variable cost per unit of producing this thing is 5, and you decide to produce 100, then you're going to pay 500, right? If you decide to lower that number to 10, then the total variable cost in that case is 50. But what about the salary, okay, of the people who work in the factory? That number is not going to change with the level of production. So the variable cost doesn't change with the level of production. Now, the thing you have to understand is that when you're talking about the total cost of production, in this case, you're actually taking the fixed cost plus the variable cost. So fixed cost plus the total variable cost, and then you know the total cost of production. But the point is just for you to understand that, yes, you can classify cost as fixed, and you can also classify cost as variable cost. Now, having said that, let us look at producing estimated costs and prices. So the point is that now that you're aware, okay, now that you're aware of the difference between direct cost, indirect costs, okay, fixed cost, variable costs, and the examples that fall within those. The question then becomes, what exactly are you supposed to do with that information? And there are three things you can do with that information. In this case, we're talking about break-even analysis, purchased cost analysis, as well as purchase price analysis. And let's talk about break-even analysis. The first thing you need to understand with break-even analysis is that you need to know what fixed cost. Whenever you're trying to figure out the break-even, okay, first of all, you need to understand the fixed costs. And then you need to understand the variable cost. And you need to know that the fixed cost plus the variable cost will give you the total cost of producing that particular thing. Now, once you have the total cost of producing that thing, then you also need to know what exactly is the selling price of that thing. Why? Because the idea here is that when you sell that thing, okay, when we sell, let's say this thing, the selling price is 100. It means when you sell 1,000 of these, then we've made, 100,000, right? And that becomes our revenue. That's important. That becomes our revenue. It's not our profit, it's our revenue. It's just what we've made from the sales. We still need to figure out the expenses, subtract from that revenue so that we know if you're making a profit or a loss. So with break even, okay, the break even point, what is that? Before you start analyzing it, okay? So what exactly is the break even point? So the break even point, okay, we're talking about a point at which we are not making any loss and you're not making any profit. In short, the revenue we make from selling this thing, okay, that revenue is equal to the cost of producing that thing. And how do you arrive at the cost? We've said fixed plus variable to give us the cost. So that's it. Now, the question then becomes, how many of these things do we have to sell so that we hit a point where we aren't making a profit and we aren't making a loss? Because any extra sale past that point means profit. So in short, we need to understand something else, something called the contribution. Because the key thing here is we are going to incur fixed costs nonetheless, right? So for every item that we sell, how much of this item, okay, how many of these items are contributing towards taking care of the fixed cost? That's actually the thing with the break-even point. It's just figuring out how many of these items, not these, but the items, do we have to sell so that we cover our costs, our fixed costs specifically. That way we are breaking even, because the other costs are variable costs. Those ones will increase with the level of production. So if we've produced enough to cover the fixed cost, it means the next ones that you're selling, well, it's just like when you're dealing with marginal pricing. So the next one that you're selling doesn't really, we've already covered our fixed cost. So that is just profit. Anyway, those are too many words. Let's look at this from a practical angle. Let's assume that we are dealing with a bakery business. And in this case, the bakery needs to know how many cakes they need to break even. Basically, how many cakes do they need to sell so that their total revenue, remember what we've said, revenue, okay, sales times, okay, the number that we've sold. So anyway, so that their total revenue is equal to their total cost of production. How many cakes should they sell? Now, there are things they need to understand. There are things they need to figure out at this case. And in this case, we'll need to determine the fixed cost, the variable cost per cake, and the selling price. So let's assume that the bakery has a fixed cost, okay, of $2,000 per month. Variable cost per cake is $5, and the selling price of each cake is $15. So now the formula, okay, for break-even point in units, in this case, is break-even point is equals to fixed cost divided by, well, contribution, which in this case is selling price minus variable cost per unit. So selling price per unit minus variable cost per unit. And so the first thing that you obviously need to figure out there is what is our contribution. Since we have those three numbers, you have the fixed, you have the variable, you have the selling price, right? So in other words, how much of this, when you sell something, so the cakes, but in this case, let me say this plus, when you sell this thing, that number, that selling price, how much there is contributing towards taking care of the fixed cost? And usually the answer will depend on what's the selling price minus the variable cost. Then the answer we have, that particular number is enough to give us profit and also take care of the fixed cost. Okay, that is selling price minus variable cost. And in this case, it will be 15 minus 5, which is 10. So break-even points in units will be the 2000. Remember, fixed cost was 2000. So 2000 divided by 10, and that means 200 units. In short, the bakery needs to sell 200 cakes to cover all of its cost and break even. There are two things. If you look at that, there are two things that you need to understand. Number one, if the bakery sells the cakes, okay, if they sell fewer than 200 cakes, it incurs a loss. If the bakery sells more than 200 cakes, it starts to make a profit, right? And here's what all that means. So look at it this way. Assuming they sell 250 cakes, then total revenue, in this case, will be 250 times 15, okay, the selling price, which is 3,750. So the total variable cost in that case will be 250 times, remember the variable cost per unit was 5, so times 5, and that is 1,250. Fixed cost, 2,000, which is constant, right? So the total cost, okay, will be 1,250 plus 2,000, which is equals to 3,000 rather, which is equals to 3,250. So from this number, we can say that profit, in this case, so total revenue minus total cost is equals to 3,750 minus 3,250, and that is equals to 500. So after selling 250 cakes, the bakery makes $500 in profit. So the break-even point is important because, again, as an analysis, it is important because the supplier needs to understand at what point are we on. Because if they're selling those units and the units they're selling to you are below their break-even point, then you know they're in trouble. So they will push for a higher number because they need to cover that particular break-even point. And if they already passed that point, then they know that they're making profit. So then they might give you a discount and things of that nature. So that is the reason why understanding the break-even analysis or the break-even point, because if you understand it, you're analyzing it, is important. So anyway, if there is any question, ask. But that's the key thing, right? Fixed cost divided by contribution. And contribution in this case is selling price multiplied by, or rather selling price minus the variable cost. So that gives you break-even points in units. In short, how many units do we need to sell so that we can cover our costs, okay? Or so that our revenue, by selling them, is equals to our total cost. And then anything past that becomes profit. Let's talk about procurement cost analysis, PCA, right? Now, procurement cost analysis is a tool that is used to analyze the cost of things bought so that strategies can be developed for producing cost and at the same time improving supplier relationship. So think of it this way. If your goal in procurement is to increase your profit by reducing your cost, right? So that's the thing. You want to increase your profit. And you've decided that the one way to increase your profit will be to cut back on your costs. Then obviously the first thing, or the thing that you have to be very careful with, is exactly what is it that you're purchasing, because if you purchase something, that is cost. So you need to look at that and make sure that you're only buying things that you need so that you reduce on cost. I mean, it's fairly straightforward. And all this just depends on finding answers to questions like, which costs are both necessary and legitimate in manufacturing this product or delivering this service? Are the values of these necessary cost items reasonable? Is the overhead allocation to this item potentially subsidizing another item which the supplier sells? Is the basis for allocating overheads reasonable? If not, can the organization challenge the allocation method so that it is more to its benefit? Has the supplier included allowance for contingency? And does the organization agree that these allowances are for legitimate reasons? Are the resulting profits reasonable but not excessive and sufficient to keep the supplier motivated and interested in the organization's account? If you look at something like that, you quickly realize that there's a lot going on there. And so this is not something that you're going to be doing every time you want to buy something. Like every time you want to procure something, you're like, okay, let's do the procurement cost analysis. Not really, right? Which is why segmenting your purchases are important. And here's one way to do that. In this case, you're looking at procurement in terms of nature of the purchase. Is it one-off? Is it ongoing? Against type of the supplier relationship needed, that is this arm's length or strategic alliance? And so you end up with 4 quadrants. That is number 1, leverage. So these are items purchased in large quantities that are made for stock. Number 2, low impact. That is low unit cost items. 3, strategic. Items that are important to distinctive competency or important for the future of the organization. And then you have critical projects or long-term capital investment. You end up with those 4 quadrants. But then the issue here is not just the quadrant. The issue here is figuring out the strategy that you're going to use in each of those. The cost strategy, okay? The cost strategy that you're going to use for any product that fall in those quadrants. Because think about it. Critical, okay? You're dealing with critical items. That is not going to be the same as if you're dealing with, say, the low impact, okay, or low cost item. Because in that case, with low cost items, you just look at whatever suppliers are selling for. So those are the scenarios where you just request for quotations and then make a decision. But with critical items, both the relationship and the results are important in that case. So you really want to create an alliance with this. Anyway, here's the thing. So here are some of the strategies that you're going to be dealing with. So with leverage, the focus is on cost analysis. With low impact, the focus is on price analysis. With strategic, the focus is on continuous improvement. With critical project, the focus is on life costing. Having said that, you see, that was procurement cost analysis. If there is any question, you ask. So the idea here is just, we are in procurement. Our aim is to cut back on our costs, right? And so, because we want to increase our profit. I mean, usually that's the only reason why you cut on costs. Well, that's the important reason. How are you going to do that? And then it will first of all depend on what you're buying, because we just can't keep on doing this for everything. Then we say, how do we know that whatever we are buying, okay, is important? Then we decide, let's put them into 4 quadrants, right? And so based on these quadrants that they fall under, we apply relevant strategies depending on the quadrant those products or services fall under, and then you have your solution. Now, if there is any question, as always, you ask. Let's move on. Now, let's talk about price analysis. And in this case, price analysis is an approach for testing whether or not the price paid for goods or service is fair. And here's a simple way to understand that, okay? So let's assume that you're dealing with the procurement team of a mid-sized company. And this team wants to buy office supply because those are low-impact products, okay? Usually, those are the sort of things that you do price analysis for. Because if it was strategic items or goods, then you're talking about procurement cost analysis. So supplies, okay, office supplies. And in this case, that procurement team will be involved in doing things like gathering data on prices and then analyzing the prices from the various suppliers, negotiating with the suppliers, and then making a final decision regarding, which supplier to go with. The thing you have to remember with price is that in the long run, suppliers must cover all their costs, otherwise they will not make a profit and will go out of business. In the short run, price is dictated by supply and demand. In other words, competition. Why is that a big deal? Well, that is a big deal because, look, while you might be interested in, getting the lowest price, the supplier is not interested in selling that thing at a lower price. So at any given moment, you're just going to be on 2 extreme ends, and then there is that zone of potential agreement which you come to. Okay, that is where your answer, or rather your price, is likely to lie under. Anyway, all this, okay, price analysis, all these it sort of just comes down to understanding costs, and that is the reason why with cost, okay, once you understand cost, like fixed cost, variable cost, direct and indirect, you are in a position to do things like break-even analysis. Okay, figure out at what point are you not making profit, or are you making profit? Procurement cost analysis, so that you know the sort of item that you're buying. Okay, if you're going to reduce cost, which strategy do you use? And then price analysis, which is pretty much what we've just talked about. Okay, is the price fair or not fair? Those 3 things are important if you understand. Okay, your costs. Okay, specifically direct, indirect, fixed, variable. Now, having said that, let's move on. Let's talk about competitive bidding. Competitive bidding is another way of doing your price analysis. The idea here is that rather than going out there and doing your research, why don't the suppliers just compete and then you get to pick the price which makes sense to you as the buyer? So that's the thing. The suppliers they submit their bids and then you look at them and then you decide this is the one that you're going with. But as straightforward as that sounds, it's not always the case that you're going to use it. So there are moments when competitive bidding makes sense. There are moments when it doesn't make sense. So the question is, when do we do it or when do we not do it? So competitive bidding can be used when the value of the purchase is high enough to justify the cost to both sides in preparing and analyzing the bids. The specifications are explicit and clear such that suppliers are able to estimate the cost of providing the service. The market must contain an adequate number of suppliers to ensure competition. Suppliers must be technically qualified and actively want the contract so that they are willing to be price competitive. Now, regarding when not to use these. So these don't make sense if, or rather when, it is impossible to estimate cost with a high degree of certainty in situations where price is not the only variable. For example, the specification, service level, and service levels may be negotiated, okay, maybe the negotiable variables rather. If changes to the specification or some other aspect of the contract are anticipated. Now, in that case, we're not going to go with the competitive bidding. So the point here is just for you to understand price analysis. So you can just look at a price and decide, okay, yes, we want to buy the stuff. Is that price fair or not? Or the suppliers can just bid and then you look at their prices. So in this case, they're just bidding with prices, right? And you look at the prices and then you decide which one are we going to go with. So that's the thing, all right? If there is any question, you ask. Let's talk about estimating the cost associated with all life asset management. Now, costing over the life assets, service, or building is essentially within the procurement process and the wider analysis within the business case. So the idea is that when you're dealing with pretty much whatever asset that you've acquired, okay, that you've bought, then you realize that there's more to it than just the price. I mean, at this point, you know that, right? So it's not just about the price of acquisition. There is more to it than that. And so what about the entire life cycle of that project or that product, okay, or that asset? So how much will that cost? Costing mechanisms have evolved over the years and a number of different terms have risen. And this is where you start hearing terms like whole life cost, WLC, total cost of ownership, okay, the life cost, all that stuff. The key thing here is not even the terms. I mean, the terms are important, but the key thing here is to understand the concepts that are going to be used or the concepts that are associated with such things. And we're talking about acquisition, things like acquisition cost, that is purchase price, inward delivery, receipt and handling, process and maintenance costs, which include use of an asset, storage, maintenance, packing, okay, dispatch, preparation, production, manufacturing, insurance, and overheads. We have end-of-life costs, in this case, things like disposal, okay, repair, recycling. We also have non-value adding process such as scrap, okay, or rework, or other disposal costs. Now look, you can go into the theory of all that, and then you start looking as if you're talking about like M7, whole life asset management. But in this case, to understand it, let's just look at it from a practical angle. And in this case, let's assume that we are dealing with a battery, okay? So specifically, a nickel metal hydride battery. So the cost of a pack of 4 is $9. The battery life, 7 hours. Number of packs needed for 1,000 hours of use are 1. Why? Because the batteries are rechargeable. The purchase cost is 1 times $9, so that's $9. Cost to buy recharge unit is $15. Cost of energy needed to recharge batteries for 1,000 hours of use is $2. disposal cost 0.06, okay? So now in this case, the total cost will be $26, okay? So $26.06. Now if you look at that, you quickly realize that when you just thought you're going to spend $9 in buying the battery, the truth is, yes, you spent $9, but then the entire life cost of that battery is going to be $26. So there are these other costs that you're not factored in if you just focused on the price. So that's the thing here. And with that, let's move on and talk about calculating whole life cost or total cost of ownership. So when you're calculating such, obviously, when you have an asset, you're trying to figure out the total cost. First of all, the calculation will depend on the asset you're dealing with. So that's the thing we have to understand. But there are things, okay? There are things that will, there are common things in all these calculations. So those are the ones that we're going to talk about. I mean, the way you go about it is different, but the mechanisms are more or less the same. So in this case, stage 1 will be the planning. And at this stage, you need to be clear about your objectives, which could include things like determine a budget for the asset being produced, okay? To help clarify the contents of a contract, to identify any support that might be needed to use the asset effectively and efficiently, to help improve the specification of the asset in order to reduce cost, as well as to identify the range of output that the asset can achieve before additional costs need to be incurred. So once you know, this is the reason why we need to do these total costs, okay, of ownership or of the cycle. Then the next stage, stage 2, is preparing the various cost models that you're going to use. So figure out the cost models that you're going to use so that, you plan, in short. So stage 2 is just preparation, where you test the various models for calculating the whole life cost. And this will not only help you to choose the best model for the purpose, but also to identify any components of cost that need to be investigated further in order to get more accurate results. And after going through all these models, right, the ones that, and then okay, so these the one that you're going to use, or these the accounting principle. I mean, it depends on your companies and how you do things, right? Then obviously the next thing is execute, so implement. So stage 3, implementation. That is the final stage, is to implement the model to get the results and then make arrangement for regular recalculation to find further opportunities. Look, that's the thing, okay? So if you have any question, ask. The whole point here was just for you to be in a position to understand, basically to identify how cost and prices can be estimated for procurement activities. And in doing that, there were 4 things, okay? Or there are 4 things that this entire process should have taught you. So you should be in a position to understand the types of data that can provide price and cost information, the difference between direct cost and indirect cost, how to produce estimated costs and budgets, as well as estimating the cost associated with whole life asset management. So, yep, if there is any question, as always, you ask. See you in the next video.